Hi everyone, it's Matt Barnes here. I'm the lead trainer at Safety in the Market, and in this video I want to talk about trading the easy way. There are many different ways that you can trade and make money from trading. Some are better than others. Personally, I use the methods of WD Gann as taught by Safety in the Market in the Active Trader program. But when you look at the different approaches people use to make money in the market, you can boil them down to one of two different ways. There's an easy way and there's a hard way to make money from the markets. And I'm going to show you both of those ways in this video. Ultimately, your trading success is going to come down to just four things. And those four things are how often you're right in the market, so how often you correctly pick the direction of the market and take a winning trade, how often you're wrong in the market, how much money you make when you're right, and of course, how much money you lose when you're wrong. And depending on your different combinations of these four things, you might be trading the easy way or you might be trading the hard way. Let's explore this in a little bit more detail. Let's say that you take 10 trades. You're right 7 times, but you're wrong 3 times. We would say that your success ratio from your trading is 70% or 7 out of 10. Now, this is a little bit simplistic. You're going to take plenty of trades where you have a break even, where it's neither a profit or a loss. But just for this example, we'll say your success ratio is 70%. If you're right 7 times out of 10, surely you're going to make money, right? Well, not necessarily. Whether or not you make money is going to come down to your reward to risk ratio. So if you're right on a trade, you're going to make money from that thing. And we call this your reward for the trade. If you're wrong on a trade, you'll lose money on that trade, and we call that your risk on the trade. Your reward divided by your risk is called your reward to risk ratio, or your RRR. Some people will refer to it the other way around. They'll say the risk to reward ratio. I like to say reward first. I like to focus on that because that's the most important thing. And in our case, we want that to be the biggest part of the ratio. So when we talk about reward to risk ratio, we're talking about the ratio of how much you make when you're right divided by how much you lose on a trade when you're wrong. Let's look at 3 examples of that. And I'm sure as we go through these, you're going to spot straight away trading the easy way and trading the hard way. Let's look at example number 1. In this example, you're right 7 times out of 10 when you take your trades. And when you're right, you make $100 profit. So that means your 7 winning trades will bring $700 profit into your trading account. On the flip side, when you're wrong, you're going to lose $100 on each trade. So 3 losing trades out of 10 means that you're going to lose $100 3 times for a total of minus $300. Now, it's important to keep in mind that the risk on your trade is determined by you. You might choose to risk $100 per trade. You might choose to risk $10 per trade. You might choose to risk $100,000 per trade. But the important thing is you're in control of how much you risk. And again, you're in control of how much you target for a profit or a reward when you're right. So if we combine the $700 and the negative $300, that leaves us with an overall profit of $400 for 10 trades. In this case, the reward to risk ratio on the trade is 1 to 1. That's because your risk and your reward are the same amount. So your reward, $100, your risk, $100. 100 divided by 100 gives us a 1 to 1 reward to risk ratio. Now, in this example, you're profitable. So well done. If you are a profitable trader, that automatically puts you into the top tier of traders, given that more than half of traders lose money from the market. Being profitable is a good thing, right? Well, yes, it is, but let's look at 2 more examples first. In the second example, again, you're right 7 times out of 10, and again, when you're right, you make $100 for each of those winning trades. So that leaves you with, again, 7 winning trades times $100 or $700 of profit. Have a think to yourself for a moment. With those next 3 trades, how much money would you have to lose on each of those trades to wipe out that $700 of profit? Well, we'll find out in a moment because, for whatever reason, on those losing trades, you've risked $250 on each of those trades, which means that 3 losing trades times negative $250 leaves you with negative $750. What's the net result here from those 10 trades? It's a loss of $50 for 10 trades. You may as well have not traded. You may as well have gone to work. Now, look at the top of the screen there. You are right 7 times out of 10. Your success ratio is 70%. That means you're pretty good at calling the market. So it's not your success ratio that has let you down here. It's your reward to risk ratio that has let you down here. In this case, your reward to risk ratio is less than 1. It's only 0.4 to 1 unit of risk. So $100 divided by $250 when you're wrong, that's a 0.4 to 1 reward to risk ratio. And I think it goes without saying in this example, you're not profitable. And that's not where you want to be as a trader. Let's look at one more example now. In this example, you're only right 3 times out of 10. Think back to when you were in high school or university. If you got 3 out of 10 correct on any test, you would be deemed a failure. And people often approach trading the same way and they think, oh, 3 out of 10, what a terrible result. But that's your success ratio. Let's have a look at the reward to risk ratio. In this example, you're only going to risk $100 on each trade, but you're going to look for a reward to risk ratio of 10 to 1. So let's have a look how that pans out. When you're right, you make $1,000. Think about that for a moment. Every time you trade, if you lose $100. But if you're right, you make $1,000. That's 10 times what you were risking. In that case, you have 1 winning trade. It's going to take you 10 losing trades just to get back to break even. And keep in mind, when we talk about risk, that's the maximum risk on a trade. And often in trading, even when you have a loss, it's not your maximum loss. It'll be $95 or $92 or something like that. Can you see how if you skew the reward to risk ratio in your favor, you're really giving yourself the very best opportunity for success? Now, in this example, those 3 winning trades alone net you $3,000 profit. And because we're only risking $100 on each trade, you can have 7 losing trades times $100 for a $700 loss. But when you combine them together, you still end up with a profit of $2,300 in your 10 trades. And that's with a success ratio of only 3 out of 10 or 30%. So in this case, even though your success ratio is fairly low, you're a profitable trader. So looking at just those 3 examples, when it comes to being a successful trader, which do you think is more important, the success ratio or the reward to risk ratio? If you said reward to risk ratio, you're 100% correct. Now, obviously, you have to have some kind of success ratio because if you're only right 1 time out of 100, you're going to have to make 101 to 1 for your reward in order to be a profitable trader. But you don't have to strive for perfection and to get every single trade right. What you should be focusing on is looking for trades with the bigger reward to risk ratios. Now, I've been trading for over 15 years, and during that time, I've acquired a lot of books and courses, and I've been to a lot of seminars. And we're told that we should aim for a 50% or better success ratio, and we're told to target a 2 to 1 reward to risk ratio, and that if we can achieve these 2 outcomes, we will be profitable traders. Now, again, being a profitable trader is a good thing, okay? It puts you in the top tier of traders. However, just because we're profitable doesn't mean that it's the best way to go about doing things. In fact, I actually call this trading the hard way. Trading the hard way, imagine you take 50 trades. You risk $100 on each trade. You're right 50% of the time, and you have a 2 to 1 reward to risk ratio. So that means if you're right, you're going to make $200. If you're right 50% of the time, 25 times $200 means $5,000 worth of profit. But you're also wrong 25 times, so you're going to lose $100 25 times, or $2,500. And that means your net result is only $2,500 profit from 50 trades. Now again, I don't want to ignore the fact that this is still a profitable way of trading. And as you grow as a trader, you might increase that risk of $100 per trade into $200 or $500 or $1,000 per trade. And if you're risking $1,000 per trade, well, your 50 trades are going to make you $25,000. If you can do that 4 or 5 times a year, well, you can make a living as a trader. But as I said, that is trading the hard way. I know that it's conventional wisdom, but there are better ways out there, and I'm going to show you how now. If we look at the Active Trader program, the Active Trader program tells us to focus on large reward to risk ratio trades. So we aim for a 10 to 1 or more reward to risk ratio. How do we do that though? And that's the thing. You're probably thinking, but Matt, if I could take 10 to 1 trades, I'd be taking them. I wouldn't be settling for a 2 to 1 reward to risk ratio or a 0.4 to 1 reward to risk ratio. I'd love to take a 10 to 1 trade, but how do we do it? The way that we do it is that we enter close to market turning points with a small amount of risk. Let's say that you're targeting a 500-point move in the market. If you're risking 100 points on that trade because your stop loss is a long way away, you're only going to make about a 4 to 1 reward to risk ratio because 100 points of the move will have gone. That leaves 400 points remaining or a 4 to 1 reward to risk ratio. But if you can get into the trade with, say, 50 points of risk, that's going to leave you 450 points of profit or about a 9 to 1 reward to risk ratio. So the key there is to lower your risk on the trade. And the way that we do that is by getting in as close as we can to market turning points. Now, how do we do this? How do we get in close to market turning points? There's one skill that you need to focus on, and that is the art of price forecasting. And I'm going to talk about that a little bit more in another video, but it's all taught in the Active Trader program. Let's look at a recent example. This is a trade on the Australian dollar, US dollar currency pair, and it's one that I walked the students through in our Active Trader program coaching. The Australian dollar had a high here on the 13th of January 2022, and that high was 73.14. I took a short trade here, expecting the market to go down, and I entered at 72.91. So the entry is 72.91. I put a stop loss 1 point above the high at 73.15, and the target was down here at 69.93. And the market went all the way down there. But just because the market went in my direction, that's not what made it a good trade. What made it a good trade, or in this case, a good 2 trades or a good campaign, is that the reward to risk ratios on these positions were in excess of 10 to 1. On the second trade, I had an entry at 72.62 and a stop loss 1 point above the high at 72.77. So there are 2 trades underway here, each with the same target. And let's see how this played out from a reward to risk ratio perspective. In entry 1, entry was at 72.91 and the stop loss was at 73.15. And that gave us a risk of 24 points on the trade. That calculation comes from taking the stop loss at 73.15, the higher number, and subtracting from that the entry price at 72.91. So the risk is 24 points. The target is 69.93, and that gives us a reward or potential reward, because we don't know the trade's going to go there. We could be wrong and we could be stopped out. But the reward or potential reward is 298 points. That's 72.91 minus 69.93. If we take our reward, 298, and we divide by our risk of 24, that gives us 12.4, which means our reward to risk ratio on that entry number 1 is 12.4 to 1. So if you're risking $100 on the trade, if you're right, you're going to make $1,240 on that trade. Entry number 2 was a week later and it was at a lower price. It was at 72.62. Now, most people think if I get into the market at a lower price, there's going to be less reward for me and it's not going to be as good of a trade. Well, let's see how this one panned out. Entry was at 72.62. The stop loss was up at 72.77, and that gave us a risk of 15 points on the trade. The target is the same at 69.93, and this is something that you'll often do in trading when you're trading those bigger picture swings. You'll take an initial trade and then you'll take an additional trade, and they'll have the same target there. In this case, 69.93. So the reward here is 269 points. Now, that's less than the reward on our previous trade, but the key here is the risk. The risk is quite a bit lower at 15 points compared to 24 points on the last trade. So let's do our reward to risk calculation. 269 divided by 15 is 17.93. That's a reward to risk ratio of 17.93 to 1. Now that is a healthy reward to risk ratio. Even if you missed the first trade, you've got a second trade there with an even better reward to risk ratio. So in summary, trade 1, 12.4 to 1 reward to risk ratio. Trade 2, 17.93 to 1 reward to risk ratio. And if you combine those together, you've got a total reward to risk ratio on the trade of 30.33 to 1. And I can tell you, the day after I entered the second trade, I had a small profit locked in on both of those trades. So it was at that point, because I got in so close to the tops, not only do I have a large reward to risk ratio, but I can move my stop to entry plus commission or to a break even or better position very, very quickly. Now, it doesn't matter how much money I was risking on the trade. Have a think about how much money you risk on a trade. If you're risking $100 on a trade, that's a profit of just over $3,000 for about 2 weeks of trading. That's 30 to 1 or just over 30 to 1 from 2 trades. Now, compare this to our previous example of trading the hard way. We took 50 trades and we only made a $2,500 profit. And that was still risking $100 per trade, but we had a 2 to 1 reward to risk ratio and a 50% success ratio. Can you see the difference there? It's the same amount of risk per trade, but in our case, we made more profit and we made 48 fewer trades. Now remember, every time that you take a trade, you've got to do your analysis, you've got to find a setup, you've got to fill in your trading plan, and then you've got to sit in front of your computer screen in order to place that trade and get into the market. And sometimes you're going to do all of that work and a trade won't get triggered. So then you have to do it again. So if you're trading the hard way, 50 times you're going to sit down and do your analysis. 50 times you're going to look for a setup. 50 times you're going to fill in your trading plan, and 50 times you're going to be sitting in front of the computer waiting to take a trade. Compare that with focusing just on those bigger picture turns on the Australian dollar example that I showed you. Same amount of risk, more profit, and 48 fewer times. And that, my friends, is what I call trading the easy way. It saves you time, it saves you energy, it saves you effort, it saves you filling in trading plans. And it frees up your time then to go and do all the other things that you initially got into trading so that you'd be able to do. Nobody gets into trading thinking, gee, I'd love to sit in front of the computer for 80 hours a week looking for trades, or less than 1% of people would get into trading wanting to do that. People get into trading for the lifestyle. They get into trading to have more time, not less time. So if you can trade an easier way, the question I have for you is, why wouldn't you focus on trading the easy way? So where can you learn how to do this? Well, if you're an existing safety in the market student with the Active Trader Program online training, you'll know that this is a 3-step process where you've got section 1 of the training teaches you how to follow the trend so that you can pick the direction up or down on both the small picture and the large picture. Then in section 2, the focus is on finding the turning points in the market. And that's what I talked about, where we saw 73.14 and 72.76 on the Australian dollar. Those are called turning points in the market. And many of them are forecastable before they happen. Occasionally, the market will do something and you'll miss the turn, and that's fine. There's no trade. You move on to the next one. But so often, you can identify those turning points in advance. And as I said, I'm going to show you how to do that in another video. And once you know how to follow the trend and pinpoint those turning points that indicate the end of the trend, you simply need to follow step 3, which is fill in your trading plan. And all of that is covered in the Active Trader Program online training. And there's about 11 hours of videos in there. So you could get through that in a weekend easily. If you're a new student who's just come across safety in the market, firstly, welcome to the channel. It's great to have you here. If you'd like to see more videos like this, make sure you click on the subscribe button. And if you enjoyed the content in this video, please click on the like button. And if you would like to check out the Active Trader Program online training, you can do so by clicking on the link in the description to this video so that you can have a look for yourself and see if that's something that you'd like to be a part of. So at the end of the day, you can choose to trade the hard way, Or if you're like me, you can focus on trading the easy way so that you can free up time to do more of the things that you love. And I think, as I said, that's why we all got into trading in the first place. Thanks for watching the video. All the best with your next trade, and bye for now.